Okay, hello everyone. Hopefully you can hear me. Thank you for joining us for this New Capital webinar, Year-End Planning 2020 in Review, and a look ahead at 2021. This is Catherine Barr, Director of Communications at New Capital. Thank you so much for being with us this afternoon. We're going to do Q&A a little different this time, so if you've joined us on a webinar before, it'll be just a bit different. Leonard's presentation will be in three main sections, and he's going to be leaving some time at the end of each section to answer questions related to that topic. So feel free to type in questions throughout the presentations or the presentation throughout the different sections, and we will moderate and then read out any questions related to the topic at the end of each section. And you can use the Q&A tool. It should be in a menu at the bottom of your screen. Type your questions in, and then we will address them at the end of each section. And so before we get started, I'm going to read the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you for that. And finally, before I turn it over to Leonard, I'm going to launch a survey to get us started. So if you would, you should see that on your screen now. So if you would take a few moments and answer the survey, and Leonard will be with you shortly. Thank you so much.
Good afternoon, everybody. Thank you very much for joining us today. We have a very full agenda. First, a little bit of housekeeping. There's one issue in particular I'll talk about. We're going to spend quite a bit of time talking about year-end planning today and taxes, because it is possible that we will see changes in tax laws up ahead arising out of the elections that have just occurred. And so we're going to talk about that. And so I will talk about a number of things that we could do. We only have a couple of weeks to get them done. And so some of these things may be for you, and a lot will not be for you. But we'll talk about how we can go about analyzing that, and what system we have set up to be able to put in place potentially some year-end maneuvers. We'll talk about in 2020 investment results, of course, what a crazy year this has been, and I'll show you how the year has played out in investments, and then we'll also talk about some implications for 2021. We always allot an hour for our meetings here, but it's possible we'll run late. And so if you got to go, you got to go. It's perfectly fine. But I'm just warning everybody right now that there's a lot to cover, and we may get a bunch of questions, and we've got a fairly large attendance today, as people want to see what are things that we might do here at the end of 2020. I hope everybody is doing well and is healthy. I hope that you have a wonderful holiday season planned up ahead, and a wonderful new year. I hope that 2021 will be a wonderful, wonderful year for everybody. And as I said in my letter that I sent out over the weekend, we're beginning to see some light at the end of the tunnel of the vaccines. And I think the announcement today was that FDA is going to greenlight the Moderna vaccine. So that will add to the existing Pfizer BioNTech vaccine, which began to roll out yesterday. And I know that there were many, many emotional scenes, especially among healthcare workers, people who have been on the front lines risking their lives every single day to care for those who are sick and infirm. And I cannot stop thinking about these incredibly heroic people. So the estimates are that we will see a large proportion of the U.S. population vaccinated prior to summer. And so we may begin to see what looks like normality in the middle of 2021. So I think all of us have our eyes on that, and I know that the whole world is looking forward to that. I want to give you an update, and again, we'll take questions after each of these segments. The first one, I want to give you an update. I've spoken about the possibility of New Capital making an arrangement in Switzerland with a Swiss bank, and I asked whether people had interest in that, and there has been some interest in that, and I am in the process of looking over legal agreements and what that would look like. The idea behind this is simply that we would give you some jurisdictional diversification capability. Don't have any expectation that you would move most of your assets at all to Switzerland, but if you had the ability to open an account there and to have the ability to move some assets there for whatever reason, would you have any interest in that? And the initial pricing that we have coming back looks like this. Now, this is cheap pricing. The Swiss are very proud of their custody, and this is about, I'm saying we're getting a discount here of probably 30 to 40% off of what you would get if you walked right through the front door. I'm going to try to get it lower, but I can't promise you that I would get it lower. And what they're basically saying here is that to keep anything under $5.6 million, they gave me pricing in Swiss francs, but anything under $5.6 million, they would charge 35 basis points. So if you put $5 million there, it'd be $20,000 a year. Anything between 5.6 and 11.2, they dropped the price to 30 basis points for that tranche, and 11.2 to 22.5, 25 basis points, and anything above 22.5 would be 20 basis points. They want to treat each New Capital client separately, so this fee schedule would apply to each client individually, and what I'm going to tell them is we want to put all of New Capital's clients together so that we get aggregated, we get treated in the aggregate, so that these breakpoints get surmounted sooner. And that's exactly the way that Vanguard treats New Capital. We get preferential treatment on all Vanguard funds, and that's how PIMCO and so on is treated. So that's my plan, is to let them know that that is what I want. I haven't gone back to them yet. I'm still looking over the agreement. But just to give you an idea, if you said, you know what, I want to open an account in Switzerland just in case, or just so that I have an account open in Europe, in the other center of democracy in the world, so that if I ever wanted to pull the trigger and move my assets over there, let's just say you said I want to take $1 million and open an account there, that would be a $3,500 charge annually to have that account open and maintained. So let me stop there and just ask everybody with a show of hands, if that's the pricing and you said, you know what, I'm willing to put $1 million or $500,000 or something like that, and spend $2,000 a year or $3,000 or something like that to have another option for custody somewhere else in the world, keeping in mind that Fidelity charges us nothing for custody. Here in the United States, custody is very, very cheap. The Swiss charge for custody. That's just the way they are. Let me see a show of hands using your hand raise thing as to whether that would be of interest. And I don't expect that this is going to be of interest to everybody here, probably not even a majority of New Capital clients, but it would be helpful if you showed me, if you wanted to open an account in Switzerland, pay a few $1,000s a year to keep the account open and to have an offshore account, It wouldn't change anything tax-wise. We would still be reporting on standard IRS forms to the IRS. And so we wouldn't be doing this for any sort of tax preference at all. It's simply to be able to keep some of your assets in Switzerland. So if you're interested, go ahead and give me a show of hands. If you're not, keep your hand down, and this will give me a good idea as to what this might look like. Okay, very good. Thank you very much. Now, let's get on to some year-end planning issues. Obviously, the political environment affects taxes. What we have now, as of yesterday, is clearly, unambiguously, an executive branch that is going to be under Democratic control. We have a House of Representatives that is going to be under Democratic control. And we don't know what the Senate is going to look like, because that remains to be determined in a January 5th election in Georgia. Extraordinarily, both senatorial seats in Georgia are going to be voted on by the people of Georgia. I know I'm not telling anybody anything you don't know, except that we have a December 31st deadline. If we assume that you want to do any of the strategies that I'm going to talk about, the question that I'm going to get is, well, do we do it before the end of 2020? And as a financial planner, the answer is, it may be that we want to go ahead and take some action on some of this, because it's possible that the laws could change in 2021. If we get Democratic control of all three of these branches, there would be a good likelihood that we would see some changes in tax laws. If we didn't see a change of control, then there's a good possibility that we would not see a change in them, because a Republican Senate would more than likely continue to block Democratic efforts to pass changes to the tax laws. So what do you plan for? How do you plan? And the answer is, we would plan to undertake maneuvers to address the potential for changes in tax laws, assuming that if they did not take place, it did not put you in a disadvantageous position. Let me say that again, that we would plan to take some actions, assuming that it did not put you, if the tax laws did not change, that it did not put you into a disadvantageous position if the tax law changes didn't go through. That's how we would want to think about it. Here are proposals that have been made by the Biden campaign. You can think about it that way. And it's not like there is a lot of detail around a lot of these. I'm giving you, in the slides that I'm going to show you, the general idea of what has been proposed, but they're not in the specific at this point. They are just general proposals. So we would see potentially higher income tax rates at the $400,000, presumably, and they haven't specified this, but presumably at the $400,000 adjusted gross income level, we would see higher income tax rates. And quite a bit of this would represent an undoing of the tax law that was passed end of 2017, early 2018, known as the TCJA. And this would presumably represent some repeal of that, higher income tax rates at the $400,000 AGI. So if you are dancing around $400,000 in AGI, you might be affected. There is the idea being proposed that at a $1 million AGI, so if you have $1 million in adjusted gross income, and again, presumably it's AGI, the word that's being used is income. We don't know exactly what that means, like taxable income or AGI. So we're assuming that that's adjusted gross income, that the capital gains tax rate, which is currently 20% and 25%, would rise to your income tax rate, which could be up as high as 39%. The capital gains tax rate, if your income is $1 million and higher of adjusted gross income, which is presumably what we assume it to be. So if you're not dancing around the $1 million income level, then it doesn't affect you. However, if you have a big gain in stocks in a taxable account and we took gains later on, and that resulted in you having over $1 million in capital gains, that could push you into the 39% tax rate. So the portfolios that we hold for you, and this is why I try to put you into things that I believe are there for the long term, and this is going to be even more important if we see changes to the tax laws, because we're not going to want to take gains if we can avoid it, if it's going to push you into higher income tax rate. Itemized deductions conceivably could be affected. We could see a 28% of total AGI, a cap on itemized deductions. So for example, this year, and we'll be talking about this, you could take a charitable deduction provided that it is composed in a certain way that is up to 100% of your adjusted gross income. You could literally take an itemized deduction up to 100% of your AGI. Well, you wouldn't be able to do this under the proposed changes. Any whether it's charitable or property taxes or whatnot, any of your itemized deductions would be capped at 28% of adjusted gross income. Now, one of the things that happened in the current tax law that was very unpopular, especially here in Houston where we have high property taxes, is that we had our property tax deduction capped, and there is a proposal that would be removed, and that would be and state taxes as well. So that would be very popular in places like California and New York, where they have high state income taxes, and it would probably be popular here in Houston, where we have higher property taxes. So there is that. That would probably make a lot of people on the call happy that we would lose that cap that was put on at the end of 2017, capping the deduction for property tax rates. There is circulating the idea that, and this would be quite a big change, an enormous change, the step up that everyone receives on their estate after death, where your capital gains cost basis steps up to the market value on the date of someone's death, that would be eliminated. There would no longer be a step up available on your assets, on anyone's assets. And more, there would be a realization event, so on death. So the idea is that when someone dies, the government would immediately move to tax their assets, assess a capital gains tax on their assets, and the capital gains cost basis, the basis on their assets, would not be eligible for a step up. It would be whatever it is historically. And so the result of that would be the elimination of a tax benefit that many, many people count on in their estates, and that their heirs count on, that their assets will step up to a market value, and that there will essentially be no capital gains tax on their assets. That would be a huge, huge change. What chance this has of passing, I don't have any idea. But the possibility that this would occur means that that we as financial planners would have and would face a very, very different capital gains environment to manage for our clients, not just when people die, but all along the way. So I don't know how much chance this has of being realized, but it is being discussed. everyone has gotten used to an increasing, and Catherine, we'll get to the question in just a second. I see we've got a question. Everyone has gotten used to increasing thresholds on gift and estate tax exemptions, right? When I started in this business, they were at $720,000 was the gift and estate tax exemption. And then it went up to $1 million, and it's gone up to $3 million and $5 million. And now, after 2017, it's about $11.5 million, and that adjusts for inflation as well. So over time, as inflation goes up, this gift and estate tax, and we call it a unified tax credit, has gone up. And if you're married, that means that each spouse has $11.4 million in an estate and gift tax exemption. And if one spouse dies, the other spouse can inherit, so-called portability, the unused exemption of the deceased spouse. So what that effectively means is that nobody has to worry about estate taxes, which are about 40 to 45% tax on the value of an estate above the threshold. Nobody has to worry about this if their estate is under $22 million. And that's not too many people that have estates above $22 million, combined marital estate. Well, we could well see, and I would put the odds of this happening as pretty good. So what that means is that if there are any of you who are on the call who have estates, let's say $5 million and above, we may want to have a discussion before the end of the year here, because it may be, but it may not be, that there are some actions that we would want to consider in the area of trusts or gifts to trusts. Nobody takes those actions lightly. I have personal experience in my own family taking these actions a number of times over years. So we would at least have a discussion, and undoubtedly to take action would also involve your estate attorney. But we would want to at least begin to have a discussion about it, because we could see these thresholds, which have grown very substantially into the $11 million and $20 million, we could see under unified democratic control of the US government, we could see these thresholds be cut back. Catherine, question.
Yes. Okay. So question came in on that, and I'm sorry. I'll hold the rest till the end. But this one came through. If we receive a $1 million in an inheritance, would that apply to the Biden proposal?
Meaning if you receive the $1 million inheritance and the capital gain, this has to do with the prior slide talking about capital gains and the step up. And the answer is yes. That heirs, if this went through and the step up was eliminated and the government moved to tax estates immediately upon death without the benefit of a step up, then the government would, then yes, heirs in the United States would receive a much smaller inheritance, substantially, meaningfully smaller inheritance. You know, we don't know to what extent, but it could be a 20%, 30%, even 40% lower inheritance than they would otherwise have received. So this is a big deal. But yes, the question is correct. In the corporate area, corporate income tax could go from 21% back up to 28%. So where it was before the TCJA law, tax law that came about at the end of 2017, 2018. And obviously that doesn't affect a lot of us on the call, except those of us in private business. And there are a number of those on the call today, of us on the call today in that position. But it could have an effect on stock prices. Could have an effect on stock prices as but it may not necessarily, right? We can't say. There could be a lot of things affecting stock prices as that occurs. I'm going to move my thing so I'm looking more right at the camera. We can't say that stock prices would go down if this happened. We can just say that this is one of the variables, and we would see that this move more than likely would have some negative effect on stock prices, but it could be offset by other positives. So we can't. I'm warning everybody. You can't just conclude that if this happened, stocks would go down. What we could say is that it might contribute to some negative effect on stock prices. Social Security taxes. There are Biden proposals where, and right now, Social Security is taxed, whether that is through payroll or that is through self-employment tax, up to $137,000. And anything beyond that is not assessed a tax on Social Security. And there are discussions in the Biden camp that between $137,000 and $400,000 in earned income, because it's earned income that we're talking about, income that is assessed Social Security tax, that there would be no tax, continue to be no tax between $137,000 and $400,000 in earned income. But after that, at $400,000, Social Security tax would kick in again. And so this is the idea of taxing high wage earners on additional Social Security tax on higher earnings in order to shore up Social Security. So we would have essentially a so-called donut, right? There would be a hole in the middle right there between 137 and 400, no tax as we're used to right now, because right now there's no tax on any Social Security earnings above 137. But then here at 400, we would see Social Security taxes kick in. So those are the highlights that have been talked about in the Biden area. Now let's talk about some strategies. Those of you who are taking RMDs from your IRAs, for most of you, the vast majority of our clients have decided to take advantage of the offering by the government here in 2020 to defer taking your RMD here in 2020. And most of you have taken advantage of that because that means you will not have to report those distributions from your IRAs as taxable income. And so that means that those of you who have been taking distributions from your IRAs will report lower taxable income in 2020. And for some of you, that will be substantially less income. If your IRA distribution constitutes half of your income, along with, say, Social Security, and maybe there's a pension or whatever, you're going to report a lot less income in that case on your tax return for 2020, and that may put you into a lower tax bracket. Could well put you into a lower tax bracket. Well, there are some implications of that. That means, yeah, you're going to pay less taxes, but it gives us an opportunity to do this maneuver. This maneuver is a Roth IRA conversion. And I've said and recharacterization here, but let me talk about first what a Roth IRA conversion is. A Roth IRA conversion means we take some of your regular IRA and we convert those dollars and we put them into a Roth IRA. You may already have a Roth IRA, but if you don't have a Roth IRA, we would make a Roth IRA for you. The benefit of a Roth IRA is that just like a regular IRA, where the money is not taxed while it is in an IRA. So dividends are not taxed at all while they're in an IRA. Whether those dividends are coming from stocks or those dividends are coming from bonds, none of it, nothing, or interest on cash. No tax at all is paid on a regular IRA, traditional IRA or an SEP or a 401k, which is kind of like an IRA. However, when the money comes out, you pay tax on it if the money that's been put in is pre-tax money. Unlike that regular IRA, a Roth IRA, you never again pay tax on the money. So the money grows tax-free and the money comes out tax-free. So that's a big, big benefit. And in the past, because of that benefit, the government has restricted how much money can go into a Roth IRA. But fairly recently, the government has made rule changes that you could make a conversion and you could move some of your IRA money or all of your IRA money into a Roth. The problem is that you have to pay tax on it. And so if you moved all of your IRA money all at once into a Roth IRA in 1 year, then it could kick you into a very big tax bracket, and you would end up hurting yourself, because although you would move the money into a Roth IRA and get the tax benefit of being in a Roth IRA and the money ultimately comes out tax-free, you would have converted so much of it that you would have paid tax at a very high tax rate. So the idea of a partial conversion comes into play, where we convert a little bit of your IRA. The question is, how much? And it's not an easy thing to answer because there are all sorts of variables that come into play. Your life expectancy, what we expect tax rates to be in the future, how big your IRA is, how old you are right now. There's all sorts of variables. The good news is that our new financial planning system that we converted over to about a year ago has an excellent Roth conversion modeler. And so we have the ability to work with you closely to see, and JC's going to come on in a second and just give you an example to show you how we could model a Roth IRA conversion for you. So this will give you a picture of what we're talking about. And so maybe I'll stop right there, and I won't go on to any other strategies until we bring JC on. Catherine, what do I need to do to, does JC just come back? Oh, here she is. Look at that.
Hello, good afternoon.
Okay, so good afternoon, everybody. Now I stop sharing my screen and you start sharing, JC?
Uh-huh.
Okay, everybody, we're gonna try this maneuver here. So I'm gonna click stop share.
Yep.
I hope it doesn't all blow up here. Okay.
All right, here we are. All right, Leonard, can you see that?
Yeah, I can see it.
Perfect.
And Catherine, you'll let us know if we're not broadcasting to everybody, right? Yeah, okay, all right.
Great, everything's going good.
Okay, so here we have Jim and Sally Sample. They have a net worth of about $5 million. Jim and Sally are both 70 years old, and so they are retired. I don't think they're taking Social Security just yet, and or maybe they are. Hold on, let me double check real quick. Sorry.
We'll have to take it at 70.
Here they are. So they are, yeah. So they're taking Social Security at 70, but they aren't taking their RMDs yet. So here in this tax estimate, you can see this year, while they're age 70, they have a pretty low tax bracket because all they have right now is for income is their Social Security.
Okay, so hang on, JC. So let's pause. So what we're seeing there is that their tax bracket plummeted here in 2020 because the government said they don't have to take an RMD. Is that right?
That's right.
So you see that, everybody? See, the tax rate is on the left, and had they had to take their RMD, and then we're assuming because the government's going to reinstate tax rates here in 2021, to see how it pops back up. Just put your cursor there. And so see, look, everybody, see how their tax rate pops back up. It's still not that high, 14.1%, but look how low their tax rate is here at their age of 70 here in 2020. So there, look at that, 6.8%. So
Right.
the idea here is that we have some room to fill up this tax bucket by making a conversion of some of your IRA to a Roth IRA. You'll pay some tax, yes, but you'll pay it at a lower rate. So now JC's going to show you what that looks like. Okay, here we
All
go.
right. Let's go over there. Okay, so here's where the conversion comes in here. So right now, the settings that we have are a standard withdrawal strategy, which is what we use. We'll take funds from the taxable accounts first, then tax deferred, and then the tax-free accounts, which would be the Roth IRA. And so these settings here, the fill up the tax.
And that is the standard way, sorry to interrupt, but that's the standard way that we like to make distributions from your accounts. We like to start with taxable, and then we would move to the tax deferred accounts like a regular IRA or variable annuity, for example. And last of all would be tax-free, which usually means Roth IRA.
Mm-hmm.
So as your lifetime goes along, the last money that we distribute to clients generally is the Roth IRA. That gives it more time to grow tax-free because eventually the money's going to come out tax-free. So that's a standard financial planning order of distribution from accounts. Okay, sorry. Go ahead.
So actually, let's put this back to 0 here. This is going to show no conversion here. And so what we have here is we have a 0%, so no conversion, and a 0% estimated terminal tax rate. And what this estimated terminal tax rate is essentially what your heirs would be subject to. And so if, you know, the the estate tax limit right now is the $11.5 million that Leonard just discussed. And so this specific sample client, their estate's only worth $5 million, so they'll be exempt from that estate tax. And so that's why we have it set to that 0 right there.
So we're assuming that there's no terminal tax rate on this money if this money is if your estate is eventually inherited tax-free. Now, I know I was just talking about possible changes in the tax law, so you know it gets complicated, but we're still assuming that we're in the current environment and that your heirs would not be taxed. We're also assuming that money coming out of the Roth would not be taxed. So it would be a 0% tax rate. So we're assuming a terminal tax rate on these Roth assets, on your Roth IRA assets, of 0%. And so now the question becomes, all right, well, and you see the dip, you see the chart up above looks like the chart we were showing you before with the big dip there at the beginning of the chart. Can everybody see that? Show them that, JC, so that, see that?
Here.
That's exactly what we were showing you in the just prior chart, except now we've put some tax brackets. So see those bands? So we've got a band at the 10% tax bracket right there. See that first band right there is a 10% tax bracket. And then the next band right there is the 22% tax bracket. And then the orange band is the next tax bracket, which is, what is that? 24% tax bracket. So what we're going to do right now is say, all right, we're going to convert some IRA money to a Roth IRA. So here we go.
All right. So 10% didn't look like it really did anything there. So we're going to fill it up to the 12%.
Now look, it's showing you off to the right that if you do that conversion, you would have $316,000 more in the portfolio at the end, meaning, you know, the end of your life or toward the end of your life, than you would have if you didn't do the Roth IRA conversion. So what we're doing is we're taking advantage of this lower tax bracket and filling up this tax bracket here. And so, okay, now keep going here. So now we push you into the 22, we fill up even more, and you'll have $199,000 more, right? But that's not as good as the 312,000. So we went too far. In other words, we would have converted too much of your regular IRA to the Roth IRA. See that, everybody? The 199,000 isn't as good as the 312. So we would say, all right, we need to back off. And now in this case, JC, hang on. How much would we convert under this plan? This filling up the 22% tax bracket.
So if you look here, the second line, it's showing the adjusted taxable income without the conversion would be about $53,000.
53,000.
Mhm.
So and then with the conversion, the adjusted taxable income would be what?
Would be the 171 here. So you're filling up $120,000 more of the income.
So under this maneuver, filling up to the 22% tax bracket?
22.
Okay. We would do a $120,000 approximately conversion of your IRA. Does that make sense, everybody? We would take for 2020, your adjusted taxable income from 53,000 to 171,000, right? Which means we have to work closely with you to understand truly what your tax liability for 2020 is going to be, and we've got a couple weeks to do that. So we're going to be busy here at the end of the year. Now, we're going to go back to the prior setting because we like the 316. Okay, so under this, look at this. We would only do about a $27,000 conversion. So you see that, everybody? This is the optimal point. So for this particular example of Jim and Sally sample, where if we did what the software is simulating is if we did a $27,000 conversion, if we took $27,000 from Jim and Sally Sample's IRA and moved it into a Roth IRA for them, they would report $80,000 on their tax for 2020 rather than 53, but they would end up at the end of their lives with $316,000 more dollars theoretically in the portfolio. Now, can I guarantee you it's going to be more than $316,000? Please hear me, everybody. I can't guarantee you. Okay, this is just a simulation. This is the best we have for technology. I can't guarantee you that it's going to play out this way. I can't even guarantee you that the government's not going to get rid of Roth IRAs. They might, right? But as we sit right now, this could potentially have a very positive benefit. And I think there are a number of clients, many clients of ours, who might want to consider doing this Roth IRA conversion, especially this year, because of they've gotten, especially those clients of ours who are either near retirement and so or recently retired. Tell me if I'm saying all this right, JC. Near retirement or recently retired, or who are retired, where your income has dropped recently or a few years ago, so that you are in a lower tax bracket. We can run this simulation and see, well, what is the optimal amount of money that we would do a Roth IRA conversion on, such that you can take advantage of lower tax rates now that you have less income coming in.
Right. That's it.
Now, is there anybody else you and I talked about doing a demonstration on changing somebody's age. Do we want to do that, or we're good, you think?
We can try and just see what that looks like. We can change their age here. If we put them older,
maybe young.
You want to try younger?
Well, no, older. Go ahead and put them older.
Okay, so we'll do 10 years older here. Let's see what we get here.
I hope I'm not losing anybody.
Okay, so now same clients, same estate, they are 10 years older. So you can see here, they're going to have a little bit more just because there's less time for that Roth IRA to grow. That's what it's saying here.
Right, you're 10 years older, so you don't have the same amount of compounding time. And now we fill. So what do we do here?
So we were at 22 here. If we take it back down to the 12% tax bracket, like I said, a little more. So I'm assuming if we go up any higher than the 22, it's really not going to like it.
I'm not sure.
All right.
So look what happens there. If we were to push this, if Jim and Sally Sample were 10 years older than the first example we gave you, and we pushed into the 22% tax bracket,
This is the 24.
24% tax bracket, look what happens. Now the strategy tells us that you would actually end up with $325,000 less in your terminal portfolio. So you see how close it is and why we need to work closely with you to get the right amount in a partial Roth conversion. Because your specifics, your age, and your amount of money, and the amount of money in your IRA, all these things contribute. And it's why I've really been loath to go through Roth conversions in the past until we've had a really good simulation tool like we have now. But the good news is a really good simulation tool. So let me stop and just ask. Okay, JC, I think you do a stop sharing. Thank you so much.
You're welcome.
And let me ask for a show of hands if I've lost you. Okay, so if we have completely lost you, raise your hand. If we are confusing you about this Roth conversion idea, I'm not asking whether you understand every bit of it. No, I'm just asking, have we completely lost you about this idea? One hand, three hands. But most of you are saying you're okay. Or nobody's raising hands. So that's good. Everybody gets this idea of taking advantage of a lower tax rate this year, especially on RMDs, to pay some tax to convert some of your IRA. Okay, good. We haven't lost you. Okay. All right. So now I'm going to go back. Now I go back to my screen sharing, right, JC?
You'll share your screen
So
again.
let me go back, and so here we are back to my God, I can't believe I got back to this. Okay, now, so that's the Roth IRA, RMD deferrals. Let's talk about charitable. We have helped a number of you open charitable accounts, and many of you are using those successfully. And the charitable donation remains probably the most powerful deduction that you have to itemize your taxes with, especially after 2018, when the cap on the property tax deduction came into play. What remained after that, essentially, if you itemize your taxes, you file a Schedule A on your taxes, is charitable giving. And many of our clients are successfully making donations of securities into their into their Fidelity charitable account. We give securities, as many of you know, and we avoid the capital gains tax, and we get you a tax deduction on your Schedule A also. Now, there are some rules on how much we can give. We can only give 30% of your adjusted gross income in securities. If we go above that and give more than 30%, you don't lose the deduction, but you have to carry it forward to future years. And you've got 5 years to carry that deduction forward. Or you could give a combination of cash and securities up to 50% of your adjusted gross income. So in other words, if you report $100,000 of adjusted gross income, we could give $50,000 of combination of cash and securities to the Fidelity Donor Advised Fund, and you could take a full deduction in 2020 for that. Or you could give 60% cash, or $60,000, and get the full deduction. Although, as you know, I don't prefer to give cash. I prefer to give appreciated securities because we have a really awesome way to do that. And then here in 2020, the government is giving everybody an additional capability to give an additional 40% of AGI, but it has to be given in cash, and it has to be given directly to the charity. It can't be given to the Fidelity Donor Advised Fund. Government won't allow that. So the idea is you could give up to 90 to 100% of your adjusted gross income in 2020 if you topped it off with additional cash direct donations. So there is the possibility that we could pair a Roth, think about this, everybody, we could pair a Roth conversion which would increase your adjusted gross income, because we're converting some of your taxable IRA. We could pair it with some additional work in your charitable area to then bring the tax back down, if that makes any sense. Does everybody understand that? Let me again ask for a show of hands. If I lost you, raise your hand. Okay, everybody seems to get that. We can pair the Roth conversion with some sort of charitable activity. So you see that we have some close-in work to do with you if you want to take advantage of any of this. Now, I'm not saying anybody has to do any of this, okay? You may say, not interested, and I just want to go with my super low tax rate this year, and that's fine. But we stand ready to help you discuss it. There is the idea of bunching. So if you maybe itemize your taxes, but maybe don't itemize your taxes, you're on the cusp, you're close, you've got some property taxes and some charitable you want to do, but it's really close to the standard deduction, which is what, $24,000. You may say, I want to do more charity this year, and I want to double pay my property taxes all in this year here in 2020, double pay my property taxes rather than pay them in January of 2021. I want to bunch them here in 2020 and pay some charitable, make some charitable deductions. Then that will put you significantly above the $24,000 itemized deduction. We call that bunching, where you're bunching your deductions, and then next year you go back to your standard deduction, right? Because you did everything in 2020, and then maybe in 2022 you go back to bunching, or you take the standard deduction. So we can talk about doing some bunching of your deductions also. So that's a possibility. Major gifts and trusts. For those of you, as I talked about, we could see a reduction in the estate tax exemption. We have seen that thing go up, and we've seen it go down also, although mostly it's gone up. But if we saw unified Democratic control of Congress, we could see the exemption go down. And so if you have a very large estate, let's say $5 million estate or $10 million estate, something, somewhere in that area, we might want to have a discussion about whether you are interested in making some estate planning moves with gifts and trusts. And we would only want to do that with the assistance of your estate attorney. I am not an estate attorney. I have long experience in this area, but it's nothing that I would advise you to do without the assistance of an estate attorney, and may take the CPA as well. So what does this look like? It means that we will be looking at this on a case-by-case basis. If you are interested, please get a hold of us as soon as you can, and we will schedule time, probably a 30-minute meeting to get the lay of the land and talk to you about what are some possibilities. And pretty quickly, we can help you establish whether there's anything that we might want to do. Out of that 30-minute meeting, it's not going to be final decisions, but we will be able to fast track you into deciding whether something wants to be done, or we'll tell you, we don't think there's anything to do. We will run that, in the case of a Roth conversion, we'll run the simulator that JC just showed you, and we can tell you very quickly whether it looks like it might be fruitful or not to undertake a Roth conversion or some of the other areas. I'm planning to be in Colorado, but I will be working the whole time end of the year. And so we are standing by to help you if you want to take advantage of any of this stuff. December 31st is the deadline for certain things. So for charitable, that is the deadline, and also for a Roth conversion, that is a deadline. And for some of the stuff, it might be sooner. So for example, if there's additional Fidelity charitable stuff, we've had success in the past in getting something in on December 31st, but we generally like to do it before December 30th. December 30th or sooner. I want to remind everybody that the most important measure of all is 100% probability of success on your financial planning work that we do with you, okay? Whether it's taxes or investment returns or so on, the most important measure of your success is that you can meet your goals. And I want everybody to keep that in mind. It will always remain our most important North Star. The amount of risk we take for you in your portfolio, the tax maneuvers that we take for you, none of it is as important as can you meet your goals that you tell us are important to you. So I always want everybody to understand that. And so we stand ready to assist you with that as well. Let me stop and see if there are any questions, Catherine, before we get into the investment side of things. I know we're already 1 hour in, and people got to go before we get to talk about investments. We will, but I want to just stop and see any questions. Nope. Okay.
No questions have come in, but if anyone has to go, also just as a note, we're going to be putting a recording of today's webinar up on the New Capital Journal soon. So if you have to go, no problem. You can catch the rest of it on the recording. And no questions so far, but feel free to type them in anytime.
We're going to press ahead here. All right. This has been an extraordinary year in investments. And let me just get right to it. The pandemic broke out for big time in March of this year, and it totally skewed our stock markets toward growth stocks. Our portfolios hold growth stocks, but they are not exclusively growth stocks. And I'm gonna activate my drawing thing. And this is year to date. And if we look year to date, this is the column on growth. And look at the numbers of growth: 33%, 31%, 28%. This is as of just a couple days ago. Blends, which are both value stocks and growth stocks, not bad. Value stocks have struggled this year. That's year to date. But look what has happened since the market low. Since the market low, growth has been very strong, but so is everything else. Not too shabby. Stock markets are up. If you look at value, up 61% since the market low, almost 80% value stocks, medium-sized companies, small companies up 83%. Not far from these numbers, right? But again, it's a different story since the market peak in February of 20. Growth stocks far outpacing. Look what's happened quarter to date. A complete reversal. Now large cap growth is and this is since October 1. Since October 1, large cap growth is the poorest performer, and small cap value is the highest performer. And that continued again today. Look what happened today. Small cap value stocks up almost 2.5%, the lowest performer of the day. Still, in the positive, but large cap growth stocks. So what we've seen since October 1st is a reversal of the trade that played out early in the year, February and March, when everybody plunged into technology stocks. But since that time, since March of this year, we have not seen that trade continue nearly to the extent that it did. And so the market adjusted. What I want everybody to understand about what happened with investments here this year is that the market made all these enormous adjustments in the February and March timeframe. The damage was done in terms of how the markets were going to discount technology stocks versus and biotech stocks versus other stocks. It was done by the end of March. And since then, as everybody can see, since March, we've had pretty, not just pretty, very, very strong performance. This represents the quickest recovery in stock markets in history from a low. And since October the 1st, we've seen a reversal of the trade that took place in February and March. And not only are we seeing value outperform right now, we're seeing small companies outperform. We're seeing small companies outperform. Look, 27%, 24%, 30%, whether they are value, blend, or growth companies, all have outperformed medium-sized companies and large companies. So it has been an incredibly, incredibly fascinating year when a trade that absolutely exploded in February and March of this year has exploded in reverse here at the end of the year. I'm going to keep going here. Where do we stand valuation-wise? Well, as I've talked about a lot, current valuations for growth stocks are quite high. For example, small growth stocks are trading at 72 times their earnings. 72 times their earnings. Medium-sized growth stocks are trading at 39 times their earnings. That's expensive, everybody. Even large companies, you know, these are the Facebooks and Microsoft and so on, 30 times their earnings. And by contrast, we see value stocks trading at 18 times their earnings. Blends, you might think a blend is Coca-Cola, Procter & Gamble. Still not cheap. If we look at it as a percentage of their 20-year average, small growth stocks are trading at almost 200% of their 20-year average price to earnings ratio. And everybody knows that we've got everyone going gaga for tech stocks, but this is the price that people are paying. And I want to remind everybody of Warren Buffett's very famous saying. He said, "You want to be greedy when everyone else is fearful, and you want to be fearful when everyone else is greedy." And right now we've got a lot of greed going on in the market. And so as a professional financial advisor, that gives me some pause. It's not that the other areas of the market are super, super cheap, but you can see why people over the last couple of months have been moving more towards small cap value, because it's the least expensive of all of these different areas. So that's the valuation picture in stocks. Here are year-to-date returns by sector. And this looks similar to the graph I showed in the webinar we did fairly recently. Online retail up 61% year-to-date. Airlines, energy, real estate investment trusts, hotels, banks, more utilities, all these in the negative, right? Although they're a lot less in the negative, because this is all what has reversed in the October-November timeframe. Oil prices, you may have seen, have gone up to like $50 a share, and oil stocks have been on a big tear over the last couple of months. So so a lot of that has, a lot of what was a 50% loss has been cut into. These have still done well, but still not, but they're not looking nearly as outpacing of these other areas. And of course, we know We know why these things have suffered so much. It's because of the pandemic, but their shares got very, very cheap. Let's see. Clear all drawings. I want to remind everybody why we're interested in valuations. So this is 1 month Treasury bills from 1926 to 2019, and $1 grew to be $22. All right? If you invested $1 back in 1926, by the end of 2019, it was $22. If you'd invested in the S&P 500, $1 back in 1926, roughly the same time frame, you ended up with $9,237. It's a lot better than the $22 if you'd held cash. So that's why we own stocks. That's why stocks? Why do we own stocks? Because of the long-term growth. Now, if we held large value stocks but which are value oriented, $1 over roughly the same time frame grew to $17,000, roughly twice what the S&P 500 yielded. The S&P 500 is value companies and blend companies and growth companies, but if you take just the value companies, you see that you roughly doubled your growth of $1 over that period, going back to the 1920s. And if you held small companies that were more attractively priced, look at this. $1 grew to $90,000. So this is why we hold smaller companies, and we hold companies that are less expensively priced than others. We hold all things in our portfolios, growth companies and value companies, small companies and big companies. But it's why we don't exclusively chase large growth companies, because historically, look at the return, $90,000 for small value companies versus the $9,000 on the S&P 500, 10 times the growth of the dollar. So I wanted everybody to see what the historical record there is. Now, as we look ahead in 2021, the question is, all right, what's going to do the best next year? And the answer here is nobody knows. Nobody ever knows. Take a look. So this goes back to 2005 through 2019, and these are all different asset classes. Each year, right, this is 2005, right, and this is 2019. And every year you can see, let's just take, I don't know, small companies right here in the orange. Well, that year, they were 1, 2, 3, 4, 5, 6, 7th place. And then the year after, they were in 4th place. And then the year after, 2007, small companies were 9th place. And then 5th place. 2009, again, 5th place. So if you'd ask me, well, what are they going to do in 2010? I'd say, oh, I don't know, 5th place. Nope, 2nd place. And then you ask me in 2010, what are they going to do? I'd say, all right, they're going to be 2nd place. And they would have made me look bad, back to 7th place. You get the idea. There's no pattern every single year. But having said that, this is COVID cases. What do we know? Well, what we know is that we still face a virus problem, right? We know that. We know we face this challenge of the virus. But we also know that we have a vaccine. And the vaccine holds hope that we're going to bring this down. This is the 2nd peak. This is the March peak. And we have some hope that we're going to get normality. What does normality look like? Well, in the employment area, we can see that we have already climbed back down this very, very steep peak that we saw in unemployment. Look at that. We were looking at 14% unemployment earlier in the year. Very, very dramatic and traumatic. But look, we've come back down a long, long way. So we have recovered quite a bit already in the jobs area. We have started to see, these are high frequency areas, meaning parts of the economy that have lots of transactions. So this right here is TSA traffic data. And what we've seen is some healing, right? Some healing, but also recently a leveling off and a drop off here. We're still a long way from getting back to baseline in these areas. Diners, so this is the restaurant business. Look at these frequencies, and we've seen a drop off here. So we're still not healed in those areas. Hotel occupancies have leveled off, still not back to where they were. The retail shopping area is a little better. Look at that, back to sort of normal in that area. And look at mortgage applications, up way over. So we still have some healing to do in these other areas. We all know that from our own personal experience. But look what's being predicted. Look what's being predicted. So this is S&P 500 earnings per share. This is consensus analyst estimates, and we see the big drop off right here in 2020, right? The good news is that because this pandemic occurred here in 2020 rather than 1918, and our ability to continue to do business, such as we're doing right now, and the ability to have remote meetings, we've held up pretty well. And so has a lot of the world. And the estimates are that we're going to see that in 2021, meaning an all-time high, getting back to $160 a share. You may remember back in March timeframe, I did a number of webinars where we were talking about what earnings estimates were, and I made the case back then that we should all continue to try to hold on to our stocks because I didn't see that we were going to go, way down into this area, $80, $60 on the S&P 500, and in fact, we didn't. We got down to here, and beyond. This is 2022. The analysts foresee that we're going to see even higher, approaching $200. And does the stock market know about this? Yes, the stock market knows about this. I don't want anybody to think, oh, we're going to run out and buy stocks. The markets know. The markets have risen this year, right? Stock markets have risen. And one of the reasons we've gotten this recovery in stock markets that we've gotten is because the market is already foreseeing that this is going to happen. And so as we see value stocks and small stocks recover their oomph, what the market is seeing is a recovery because of the vaccine and a return to normal and a recovery of restaurants and hotels and travel businesses. And so where do we stand in valuations? Well, right now, what we see is that this is value versus growth relative to each other. And when we see this peak, that means that growth is cheap and value has been expensive. But right now we're in this period where value is cheap and growth is expensive. This is a JP Morgan slide, by the way, just so you know. So this is where we are right now, and we've been seeing over the last few months, of course, this move in cheaper areas of the market play out. And I think that's the last slide. Okay, so that's it, everybody. I made it through the investments and valuation portion of it as quickly as I could. I did want to take a bunch of time on the tax issues, and I will open it up for questions right now and take anything that you want to ask about, whether that's about investments or valuations in the market, interest rates, of course, what we've seen in interest rates, and we've made a lot of trades in client portfolios this year to move you toward shorter term interest rates. That's worked out because what we've seen is that longer term interest rates have risen over the last few months, and we've actually been a very, very good part of the market with our inflation protected bonds. Top performing part of the bond market year to date this year has been inflation protected bonds. So it's worked out well. Okay, Catherine, ready to take questions.
Sure. Okay. The first question that actually came in was early on in the call, and I missed it, and I'm sorry. Sarah asked about the Swiss bank accounts. Would the assets held there be taxed in Switzerland?
No. They would not, as long as you're not a resident of Switzerland. If you maintain your U.S. residence, you would be taxed as a U.S. resident, and there would not be, to my knowledge, and of course there's a lot more to go. I have New Capital's legal counsel is going to look at all the agreements, but all the discussions I've had with the bank is that no, there will not be any Swiss tax on those assets. You will be taxed as a U.S. citizen. You will get a 1099 from the bank, and the IRS will get the same 1099, same as you would get as Fidelity sending the 1099. And so that's that. Yeah.
Okay, great. One other question that's come in, feel free to keep submitting. How concerned are you about the recent news of Russian hackers infiltrating several government entities? Has the market responded to this news yet? Has the market responded to the news yet? Thank you, sorry.
Sure, the market responds to everything. Everything, any publicly available information, the market responds to. You know, that's why the market responded so dramatically back in February and March, especially in March, because the virus became publicly understandable at that time and leading up to it. Stock market peaked in February of 2020, and it only became available in March. My son's bar mitzvah was March the 10th, I think, and people traveled to that. And so even at that time, we didn't all understand. Portions of the government understood. We've come to understand that the portions of the government understood that the virus had already made its way into the community, into several communities in the United States on March 10th. And Hannah and I talk about that. Had we known what we knew, what is now publicly known and the government knew, we probably would not have you know, I don't know what we would have done, but maybe have done a bar mitzvah online. But we had our son's bar mitzvah on March the 10th. And so the markets react to whatever is publicly available information, including this hacker issue. And do I think that this affects stocks? No. Do I think the United States government needs to get its stuff together, however it's going to do that, and batten down its information systems? Yes. But I don't see that that's going to have any impact on stocks. It's an interesting question, though.
Okay, and the only other question that's come in is what was the name of the Swiss bank?
The Swiss bank is Vontobel, Vontobel. We have one client that has an existing relationship with the bank. The bank has been reaching out. They have an interesting strategy where they are reaching out to U.S. RIAs, and they are a highly regarded Swiss bank that has done a very, very good job through the years when other Swiss banks got themselves in trouble with American citizens attempting to evade taxes, which occurred at banks like UBS and Credit Suisse, most notably, larger banks. Vontobel is more of a middle-sized bank with a sterling reputation. And by the way, if clients are interested in going through and opening some accounts there, I will also open accounts along with you, because I always, the investments I make are in the same securities that I invest you in. And the tax strategies that I employ for you, I also do where it's appropriate for me to do them. And where you're in custody, I am also in custody. And so it's always important to me to be sitting in the same seat that you're sitting in. I take that very, very seriously. And so it's likely that if we go ahead with a custody agreement with Vontobel, that I will open an account there so that I am experiencing what other clients are experiencing. And then for those of you who are interested but aren't really ready or don't think you want to open custody in another country, perfectly fine. And then I'll be able to tell you how I like it.
Okay, I think that there's no other questions.
That's it?
No.
Oh, come on.
You did a very good job.
Oh, no.
Everything.
Come on, I was buckled in and ready for the firing squad.
You clearly answered all
Nothing?
questions. So, I mean, obviously, feel free to submit questions through email after the webinar is over today, and Leonard can get back with you. Okay, well, here, one more question came in. We've got one. Why would anyone move assets to Switzerland?
Yep. So let me see if I can say it. What we have learned in the last years is that the United States is not as stable politically as we all might have thought. That doesn't matter. That's irregardless of your political persuasion or who you vote for. That doesn't matter to me. I think we can all agree on one thing, that our country is not as politically stable as we once might have thought it was. And that includes, up to today, in the last month since the election, has thrown some surprises our way, and we may yet see some surprises. I don't know when those surprises are going to stop, and I don't know what the future holds for our country politically. I hope it's good. I hope that we have healing and that people come together on issues that are divisive. But as a financial advisor, I can't tell you that's going to happen. As a person, I can't tell you. None of us can say that's going to happen. And so you might want to have an account as an insurance policy in another country that is a democracy, that sits at the heart of other democracies, the other center of democracy in the world being Europe, in a country that has a sterling and super strong reputation for its banking services. If, God forbid, something happened in this country, maybe that could be controls on assets, control on asset transfers, where things got really to the point where the government said, we're going to either stop assets from being transferred out of the country, or we're going to monitor them more closely, or we're going to tax them. And I'm not saying any of this would ever happen. But if you had an account already open and suddenly everybody headed for the exits and said, you know what, I think I'd like to open a bank account somewhere else in the rest of the world, the exits would be very crowded at that time. It would be very hard for us to get the attention of Swiss bankers at that time. They would be busy. And so if New Capital, and I'm not telling you that other advisors are taking this action. I'm way ahead if it's ahead, or way different than other advisors. But that's where I like to think about things. But for you to already have an account established means that we would already have it set up, paperwork would be done. And if you had, let's just say that you had, $250,000 or $500,000 or $1 million in custody in Switzerland, and we already had the ability to move assets quickly. If the US government ever reached a point in the US population, and I don't expect it ever to happen, but I've been very surprised by the political strife in the United States. And as I said in my letter over the weekend, there is a strong correlation between valuations and the strength of democracies. And if our country, for whatever reasons, doesn't manage to come together, strengthen democracies, it strengthen its democracy over the next few years, it may just be as simple as, you know what, I really like being able to sleep better at night knowing that I can push a button and move assets to another democracy that has strong banking laws and protections. So I hope that answers the question. Just as I diversify your assets in stocks and bonds, and I diversify your assets in other parts of companies in other parts of the world, in bonds in other parts of the world, we have the opportunity with the talks I've been having with Vontobel to also offer diversification of custody in different parts of the world. And so that's all I'm saying. It's something that I take seriously as being able to offer to our clients. I don't make any money on it at all. Vontobel's not, they're not going to pay me anything. And as I showed you, there's going to be they're going to have a custody charge that Fidelity does not charge, and Schwab doesn't charge. I'm trying to get that as low as possible, and I may be able to get it lower, and I'm going to try to do that. But it may just be that you are a person who says, you know what, I sleep better at night knowing that I've got millions of dollars and I can move it if I want to Switzerland. Now, we would continue to handle your money for whatever money's in Switzerland and invest for you the same way, low cost funds, Vanguard and iShares and DFA funds that are 10 basis points and 5 basis points. I mean, they're getting so cheap, they're almost free. And I'm very proud to be able to put clients into these incredibly inexpensive vehicles. So we wouldn't have to have any change in that, and Vontobel knows that. So no change there. So my interest only is knowing, is that of interest among, even if it's a handful of clients, then it's something that we would pursue. I do not expect this to be of interest to most clients. I really don't. Any other questions come in over the
Yes, we've got
last few minutes? Okay.
Yes, we've got 2 questions that have come in. First one is, why should we pay double our property tax if the 10,000 cap is going away?
I didn't say the 10,000 cap is going away. I said it's been tossed around by people in the Biden group. But I did not say it's going away, and it ain't going away until it becomes a law passed by Congress, and we don't know what Congress is going to look like. So I didn't say it's going away, but it might if Democrats control all the House, the Senate, and the executive branch. It could be that changes and goes back, and then whatever your property tax is, you can still write it off. But that doesn't mean that you still wouldn't want to pay double, that you wouldn't want to double up and do bunching on your property taxes. That doesn't take away that rationale that you might still want to bunch the property tax, because that might really get you over the standard deduction. And then if you threw in some charitable on top of that, you might have a very large itemized deduction bill for that year. So just because they repeal the $10,000 cap on the property tax doesn't mean that would take away the logic and the merits of the bunching strategy. I want to make that clear.
Okay. And the last question that's come in so far is, in the current environment, where's the best place to park savings for a down payment on a house or an apartment?
Well, it depends. If this is an imminent purchase, then we have access to CDs. Fidelity has a very large CD warehouse. So let's say, for example, you thought you were going to make this down payment 1 year from now. We could invest in a 1-year certificate of deposit. I have been buying some floating rate treasury bonds for clients, which if we see an increase in interest rates will not be hurt by increasing interest rates. So I would say let's talk about that. But usually, a certificate of deposit is a good way to go if you have the money, but you haven't yet identified what the property is. That's a good way to go, because we match the duration of the security with the timing that you have. And if you need to get out of it early, we can sell the CD early, and there's a very minor prepayment penalty for it. So there are things we can do, but we wouldn't want to take a lot of risk with it. I wouldn't want to toss it into the stock market right now if this is your down payment money for a house.
Okay. And it looks
That
like
it? Mm-hmm.
That is it. That's the last question. Leonard, I'll leave you to close this out. Just as a reminder, I did send a link through the chat function of the webinar chat function with a link to our webinar evaluation, so you can let us know how the technology was today and how the content was today, value-wise, and any other comments or questions. We welcome those as usual, so you can use that link. And again, we're going to have a recording of the webinar available on the journal this week. So keep a lookout for that. If there's ever anyone you want to share that with, we're happy to have you do that. So thank you all for being here. Happy holidays. Leonard, if you want to close this
Yes. I want to say to everybody, thank you very much for spending time with us today. I hope it was helpful. Please let us know if it was. And if it wasn't, let us know that also. I also want to say happy holidays to everybody and Happy New Year. And I want to say how proud I am of our staff. Catherine and JC, some of you have heard from Egan, who's recently joined us. I want to say how proud of our staff I am. They have done incredible work this year. They have not missed a beat throughout a pandemic, through working from home, continuing to help clients in every single way, whether that's over the phone, whether that is over email, whether that's over text, whether that's at midnight, whether that's at noon. We have a fantastic staff here, and I want to make public acknowledgement of that. I couldn't be prouder and happier of New Capital staff. We are really lucky, and if you have been helped by them over the course of this year, I hope you will let them know. That's what I wanted to end on today. Happy New Year, happy holidays. I hope everybody stays safe and healthy, and I wish the most happiness and joy to you and your loved ones now and in 2021. And I look forward to the world, your world, my world, all of our worlds returning to normal over the course of the next year. I want to thank you all for your trust and your confidence. It means a tremendous amount to me, and we work to fulfill that every single day. Take care, and thank you very much.